Hey, everybody. Welcome back to today's Market Explained, a four-star podcast and media experience. This is Brian Kasal, your host. And special feature today, I'm actually coming to you from the deck of a cruise ship just off the shore of Antarctica. Now, for the regular listeners, we've been talking about Antarctica for years. And when we found out that we had enough power and analytic information to find out where everyone in the world has heard our podcast show. So in the background are all the participants of the show, so you can hear some voices back there. When we realized that we couldn't tell whether we were heard on Antarctica, we started talking all about Antarctica, see if we can get somebody to come down there. And then, of course, few years ago, one listener did listen to our podcast from Antarctica, Steve Baird, an executive from Chicago, listened to it. So, we are now official. We have been heard on all 7 continents. So now we're focused on getting down here. So we came down here. And so our next world domination goal for the FourStar podcast is to broadcast and tape from all 7 continents. We've obviously broadcast most of them from North America, done some Europe, and now Antarctica. So we still need the other 4 continents, but we'll work on that, take care of that. So that'll be a lot of fun. So this is a financial podcast. So we're in Antarctica. So what is the economy in Antarctica? It's really not much, actually. There's researchers from the U.S., Chile, Argentina, Norway, a bunch of tourism, and other countries doing research. But there's no hotels, there's no cities, there's no towns, there's no hotels, there's nothing. And so it's obviously not much of an economy at all. There are 24 time zones in Antarctica. But if you look at all the maps, only about 10 or 11 show up on the map because they're only recognized in the area where there's a research hub. And there may be a couple of hours time zone difference between research hubs because it's so big. Antarctica, like I said, is basically the size of North and South America put together, way down here at the bottom of the Earth. Primarily, as I said, it's research bases. Economy, could it be possible? Well, the South Shetland Islands, which is where we are, is equidistant to the South Pole, where the Northern Shetland Islands in Scotland are equidistant to the North Pole. And there are people that live up there in the Shetland Islands. And one of the guys running the ship today here is from the Northern Shetland Islands up in Scotland. So there are people that live up there. So why aren't there people living down here? And again, there's people that live in northern sections of Russia, Nordic countries, Canada, Alaska. So why not? And the reason is the weather is much more severe down here. Since we have a massive landmass that's covered with a large cap of ice, a massive cap of ice, and it's estimated, by the way, that 50% of all the fresh water on the planet is frozen above the landmass of Antarctica. So it's a big ice cap is all where the fresh water is. Now, of course, if all that fresh water melted, it would go into the ocean. It'd become salt water, but it's summer here right now. It's between 20 and 35 degrees between like December 15th and March 31st. Expeditions come down through April, April to November, nothing. It gets really, really cold down here. The record temperature ever was -89 at one of those stations on the mainland. So no one owns land here. It's controlled by from countries. No one lives here. Estimated 40 million penguins live here. Gin penguins, gin crab penguins, 24 million seal crab-eater seals. There's about 75 million of them. Whale seals, leopard seals, a few 100,000, and lots of whales. So there's all kinds of stories of expeditions, and they kill seals for oil blubber, and there's fuel and stuff here. But again, there's no hotels, no houses, no nothing. So there's not much of an economy. And so anyway, we just want to say hi to everybody from Antarctica, and there really probably will never be much of an economy down here because you can't really own land down here, and it's mostly for research, and the weather is too extreme. And so you can only come here between kind of December and March, and that's it. And right now today it's February 18th, and we're taping this. So anyway, that's our story for today. I'm going to be right back with another special guest.
Yeah.
Hey, everybody, we're back, and we have a special guest here today, and my friend Andy Bender. And Andy is a longtime friend of mine. Also, he knows the economy well. He's a top executive, just retired from Hewlett Packard, and a huge financial success on his own. And he came down here with me for this expedition, and we've been watching the whole economic story of Antarctica. Andy, Welcome to the podcast.
Well, thanks, Brian. It's great to be here.
So what did you see in the economy here in Antarctica?
The economy there's not much here from an economy perspective. Probably just, tourism is probably the number one. And then you have some research facilities there based on all the different countries wanting to study different aspects. So not much here for our economy.
Now, you can slaughter seals and stuff, but they're kind of against doing that. That's the way they did it in the 1600s. They'd come in and slaughter seals and, use whale blubber and stuff like that. But that's not going to fly anymore, is it?
I don't think so.
All right. So, and in the end, we kind of vote that there's really not much economy down here at all.
Not much here, but a lot of ice. In fact, I think you might have mentioned it earlier. Just confirmed that 2/3 of the world's fresh water is in the ice in the Arctic.
On top of Antarctica.
Yep.
Yeah, which is crazy.
So,
and we saw that firsthand as we approached some of the islands, and they had these massive hunks of snow on top, and that's all fresh water, right? Yep. It comes down from the sky.
Yep.
And then these things detach and they fall into the ocean. That's where the big icebergs are, which are really scary to be out there in an iceberg. But it all becomes salt water. It used to be fresh water, but then it falls into the ocean and salt water. But anyway, well, I just wanted to introduce Andy. Andy, I think no economy really here at all. Let's focus on other continents, huh?
We should, but we'll continue our research until we're done.
That's right. But thanks for being with us today, Andy. Thanks for joining today's Market Explained.
My pleasure.
All right. Thanks, everybody. We'll be back shortly.
All right, everybody. Welcome back. We just did the promo and introduction from Antarctica. I've learned a little bit about the Antarctic economy, which, Chris, is non-existent, actually. That's what we determined in our discussion. But I'm Brian Kasal. I'm your host here of today's Market Explained, and I'm here with Chris Reardon, my trusty co-host.
Good afternoon, everyone. Glad to be here and glad to talk a little bit about the markets.
Excellent. So let's not talk about Antarctica. Let's talk about the leading driver of the economy in the world, and that's America. So, Chris, what do the markets look like right now?
Yeah, so a little bit of change from kind of an asset allocation front. Last time we reported was really at the tail end of January. Since then, domestic equity still retains that number one spot, but it did weaken actually 2 points, so it's actually at 325. But still, I would say solidly in that number one position. Commodities actually did strengthen slightly, strengthened 2 points, so it kind of picked up those two. It's at 267 now. Firmly in that number two position, I would say. But once again, there's still a big gap there. I think at this point, probably unlikely we'll see that jump domestic equities, but it's something obviously we'll monitor. International equities remains in third at 213. It actually gained 1 point in that perspective. And then the bottom three asset classes, cash, which remained at 128, was equal. Fixed income in the fifth position remained equal at 80, and currencies in last or the sixth position remained equal for the week at 78. So not a whole lot of change. We saw a bunch of changes kind of the beginning that January. We definitely saw some changes, some disruption, some movement, if you will. But since then, now we've seen the markets kind of settle in, at least from an asset allocation perspective, at least in the short term. So kind of more of that steady couple points here and there movements.
All right. So seeing commodities make a big move up there with gold, and that's concern about currencies, right, Chris, and everything. So gold and precious metals are moving, and some other commodities are moving as well, right?
Yeah, I mean, gold, we talked that coffee continues to be a strong mover there. Oils actually had a little bit of a rebound here, overall from some of the beginning of the year. Natural gas has been a big one, though, for sure, especially within the U.S. is really under a cold spell, if you will. I know we've had almost a week here in Chicago of single digits and negative. So whenever you have this cold freeze, you tend to get a pop in natural gas. So far this year, natural gas has been obviously a big player.
Well, and I want to point out that while I was in Antarctica, it was 20 to 30 degrees most of the time. So it was colder here than it was in Antarctica, but that's their summer. That's as good as it'll ever get down in Antarctica. So, but we got a lot of cold weather here in America, that's for sure. And we're particularly cold, January and February in Chicago. So maybe that has something to do with global warming, right? I'm not sure. I don't know.
Yeah, I mean, who knows? I mean, or just a cycle. I mean, the last couple of years, I mean, and not to go too much on it, but the last couple of years, I feel like in Chicago, we haven't had too bad of winters from a cold perspective. Usually it's been like 1 week. So, sometimes we're just due, I guess, too.
Right. Yeah, that's right. And also, Chris, we've talked about this in the past that if the commodities are one of the top ranked investments, commodities are a cost, whether it be coffee, the cost of coffee, or other commodities. Eggs are up big. We'll talk about that. So, and any commodity that's up is a cost of business and a cost of folks. So, commodities being favored aren't always necessarily good for the economy, but when the commodity prices are running, but nonetheless, that's kind of where we are, and we've had a slower growth economy, and about half of the economy has been in recession, and about half the economy has been in strong spending, and in aggregate, it's been positive. But that's a reflection. The commodity section is a reflection, and that part of the economy is not that strong. So
yeah, I mean, I think it's been really interesting to see, and yeah, I mean, ultimately, commodities are really an input cost, right? So, in many ways, you look at steel, you look at a lot of things like that. So, when you have commodities as a broad rising, that helps us anticipate potential inflation concerns down the line. There's a lot of ramifications when commodities are running.
yeah. Well, and so far, the markets, were tough to begin this year. So now today we're taping, it's February 21st. And we're, about seven or so weeks into the year. We started out rally, and then it was a little rough for a little while. Now it's come back. S&P's up about 3.42. It was up about the same amount last episode we did. The Russell 2000, the small caps are flat, up only 0.19%. Last episode, they were up 3.8. So they've taken a haircut. And then the NASDAQ composite is up only 2.5. So the S&P is up more than the NASDAQ. So that says that the tech stocks aren't doing as well this year still, lagging the general broader market, right? So very interesting scenario. We'll see how it all plays out, Chris, right?
Yeah, I mean, I think it'll be really interesting. I mean, I think, we saw kind of a nice pop at the beginning of the year. Earnings were strong. I think we talked about that in the last podcast, but we've almost seen it kind of, a lot of that initial enthusiasm start to wear off a little bit now. And we're starting to kind of get into a little bit more of the grinding, if you will, nature we're seeing kind of right now, which, as you said, Brian, that the markets have been relatively flat. We've seen this split within the markets. Tech's not doing as well. They're getting a little bit more of there's headwinds there that they're facing a little bit, and we're seeing other companies do better and have some better gains.
Yeah. Hey, Chris. So, and on the markets, there's been an interesting trend. Honeywell is breaking into three. Their aerospace and automation division. They're going to have three divisions now, and GE did that with their firm as well, and that was kind of inevitable because GE had bought every company out there in the world, and they finally put them into different buckets. And the healthcare, they have a GE Healthcare, GE Verona, and so DuPont is now breaking into two as well. So now we're in this trend of disintermediating companies as compared to trends when they're buying companies, right, and building a big international conglomerate. So that's the strategy. You build it up, get as much return out of it, and then when it's not working anymore, you break it up again and let them do on their own. Then you build it up again 10 years later or whatever. That's kind of, we're at that side of the cycle now.
Yep. Yeah. I mean, I think obviously spinning off some of the different segments, because I mean, I think it's also, it's important, you don't want, if you have one segment, like a GE, they make washers and dryers and refrigerators, but they also make, jet engines. I mean, they make everything, right? They also have a finance department. So, you have such a broad company. You want to break it up because you want to see, you don't want, one section to drag the overall GE stock down. So if you can spin one off, it helps position the company in a better light, and maybe gives a little bit more kind of free room, if you will, for the segments of the company that are doing better.
Exactly. Cool. Though, what else is going on in the market, Chris?
So interesting news that came out this week that's kind of boiling or roiling the markets, I should say, is we got news, I believe it was yesterday, that Walmart came out, and their forecast for the sales for 2025 came in way below expectations. So, this really caused a shock to the markets. We saw a shock kind of hit the markets yesterday, and it's actually rippling through today. So yesterday was the February 20th. Today's the 21st. A lot of this is based off of people look at Walmart as kind of a litmus test for the consumer. So the fact that they're forecasting, slower sales for 2025, coupled with some of the economic data that's come out, the January retail sales were actually down 0.9% month over month, which was well below expectations. That what that does is that's pointing to the sign that the consumer might be slowing down. And that's a really big deal. If the consumer slows down, they've been really one of the surprises of this economy has been the consumer. And if that really slows down, the engine that's really helped keep this economy afloat could be going away, and that could cause issues. We could see a recession.
Yeah.
We could see flow through from there. So
Yeah.
really important thing to kind of keep an eye on and note. The other important news that came out today is United Health is taking a lot of heat. This came after the Justice Department launched an investigation into the company's medical billing practices. So I think it's down about 7-8%. So it's just continuing. We've had kind of 2 days right now, 2 or 3 days where the markets have just gotten hit really hard. One bad news after the other. So and this comes after just one thing I like to point out. It comes after January was mostly upbeat, and I would say for the most part, I think our last podcast we said earnings for the most part have been upbeat. I think with about 80% of firms reporting, I think earnings were up about 70% beat expectations. So they've been relatively good, but once again, I think the concern is looking forward, and we're really seeing that kind of play out right now through the markets.
Yes.
So going on to some economic data, since the last podcast, the U.S. Q4 GDP came in at 2.3%, which was still growing but below estimates. So we saw GDP come out. The ISM manufacturing PMI came in at 50.9, which actually beat expectations. The expectations are 49.8. So once again, anything above 50 is expansion. So that's good. They were expecting actually a slight contraction, and we still had expansion there. So that was really good to see. And then in January, industrial production increased 0.5%, and that beat expectations of 0.3%. So, it kind of plays into this mixed data we're seeing, some positive, some negative. We're seeing the consumer dying out, but we're still seeing manufacturing kind of driving on. So, that's really kind of playing into this market. So we talked a little bit about the retail sales being down in January 0.9%. That's a really big number. It's going to be really important to note that as we come into March now, we'll get the February number. If we continue to see those retail sales slow, that'll be a big, big signal as far as the slowdown in the economy. And then the consumer credit. So consumer credit came in December at 40.85 billion, which was much higher than most people were expecting. So, what does that say? I think we have a lot of the consumers are levered up. They have very high credit card balances, things like that. The inflation has really kind of ate at them. We have housing markets that hard, insurance rates that are high. So, we'll see, is the consumer tapped out? Are we going to see that kind of play out this year? It remains to be seen. Like I said, I think a lot of people were expecting that in 2024, and it actually held up pretty well. The consumer did. So, maybe it'll surprise us this year, but that is definitely something to keep an eye on.
Yeah.
Turning over to the housing market, pending home sales were down 5.5% in December from November. That's month over month. That's continuing. The higher interest rates that are still there. I think the 30-year mortgage now is clipping at 7% again. So it's actually gone back up. Is really restricting that housing market. And in January, housing starts came in at 1.36 million. I was below expectations of 1.39 million. So buildings a little bit less as well. And then January existing home sales declined 4.9% from the previous month. So, in general, we're seeing the housing market continue to slow. I don't expect that in the short term, probably to subside. And when we have this constriction right now going on, where you have high interest rates, you have high insurance rates, and then you have, I think, the unknown, which is you have these home builders there was a home builder on CNBC yesterday, a CEO of a home builder, and I think their average home sale price to the consumer was a hair under $700,000. And, it's showing that there's really not an entry level market. So something's going to have to give at some point in this market. But we'll see. I mean, I don't know. We don't know what that's going to be. But there is a demand for homes, especially starter homes, and there just doesn't seem to be the supply or the ability to provide that supply in the short term.
Right.
From the employment front, the last thing I'll mention, ADP national employment in January came in at 183,000. That actually beat expectations, which were 150,000. The non-farm payrolls, though, came in for January at 143,000, which was below expectations of 170,000. So a little bit of different numbers there, obviously different ways they kind of tally it. So you had one that beat, one that didn't, kind of a mix right there. But the average earnings year over year came in at 4.1% in January, but which was above expectations of 3.8%. So that's good to see. I mean, whenever we have the higher cost of living or anything like that, we want to see those average earnings going up, because that, is going to provide that consumer with that purchasing power that continue kind of driving the economy forward.
Yeah. Well, so kind of mixed signals on this economy then, isn't it? Really?
Yeah, I mean, I think it's really a hard economy to read right now. I mean, and then you throw into the mix, obviously, some of the geopolitical things, and then not only that, but the Federal Reserve. You can really see how it's almost a very week to week economy, if you will, depending on what's said, depending on what happens outside of the U.S. There's a lot of different things that could impact the markets.
Well, and there's a big concern about inflation. Now, the January inflation number was up. And real estate costs are up. So certain things are exploding in price. And the Fed lowered rates twice this year, but they still feel that they're restrictive. So they think they probably went too far. At least that's what they're saying now. And now you look at it and, that changes the psyche of the public. A dozen eggs were $3.84 last year on average around America. Now they're $6.23 for a dozen grade A large eggs. So those kind of things, these shocks have like a psyche issue for the public. The main fear is that price shocks now will happen from tariffs and the deportations. What's going to be the impact of that? So, and much of this has been pushed by the media opponents of these tariffs and deportations. That the president obviously is not popular with the media, and so they're kind of pushing this narrative, and that could change how inflation plays out if everybody has a negative view of it. Now Trump is doing all these tariffs, Chris, and some of these tariffs, of course, last time he did some tariffs and they didn't really matter at all. Inflation was really low, so they didn't matter last time. This time he's doing some with trying to get political things changed, like the border and other things unrelated to the economy. But the China tariffs are there, and they're across the board right now. So they're one of our largest trading partners, and so that increases costs 10% across the board. So we'll see how that plays out. That could be inflationary with prices. So we'll see how things go. Obviously, China is a geopolitical rival. Their stated goals to try to take over the world economy and be the leader and replace the U.S. as the leader and the reserve currency. So all those things are at play here. So it's economics, but it's also politics. Now, Chris, you got some GDP numbers.
Yeah. So, switching back to the kind of international front, Mexico came out with their GDP number for Q4. And Mexico's GDP actually contracted by 0.6% in Q4, which was the first time it's contracted in more than 3 years. Most of Mexico's GDP was actually dragged down, not by the tariffs. It was actually by their kind of primary sector they classify as, which is farming, fishing, and mining. That was down a staggering 8.5%. So that had a significant drag to Mexico's GDP. So, that'll be interesting. I think you made a great point, Brian, as far as, we don't really know, or, the tariffs, yes, some of them went into place, but we haven't seen those impacts yet. And that's not going to play out for probably another quarter. So it's probably going to be another at least 2 to 3 months before we really see the full impact, or begin to see some of the impact of the tariffs. So that will be interesting to see. It remains to be seen if we're gonna, put tariffs on Mexico and Canada. Obviously, those were delayed a month, so we'll see if those go into effect. But a couple other things from the international that are really playing a role. Kind of eyes are back on Japan. So the Bank of Japan is back in the headlines with a potential rate hike next month. This came as Japan's inflation hit 4%, which is the highest it's been in 2 years. You know, what does this matter, I guess, with the US markets? There is a lot of traders, and we saw this back in August when we saw the reverse carry trade, which we've talked about. You know, is that completely unwound? What are the ramifications there? So we'll see. That could still have a major volatility impact on the US markets. The Bank of Japan came out. They signaled that they are going to kind of stay on the sidelines and, you know, hold as far as keeping yields somewhat subdued. The 10-year Japanese government bond hit 1.45%, which is a 15-year high. So even though in the US here, almost 1.5% seems really low, if you have to remember, Japan's used to, in some cases, negative interest rates. So 1.5% is a very high interest rate there for them for their bonds. So it's really important to see and kind of how that plays out. And we could see you know, their government bonds, the JGBs, go up to even 1.5, 1.6, even 2% over the next couple of years, which is going to be a very big deal. And then the last thing I think from an international perspective that everyone's keeping their eyes on is this weekend in Germany, we have the election. So obviously that could have major ramifications. Defense spending, there's a lot of posturing going on, obviously, with the EU, with our new president, Trump. It'll be really interesting to see how that plays out. It's really an odd election in Germany this year as well, because you have, as we think about it, you think of like the right side, the left side. And when you look at the Europeans, they have kind of coalitions that form. So they have multiple parties. But the kind of center-right party, which is slated to win, I think it's got about 30% of the vote, has said that they will not work with the far-right party, which has about 20% of the vote. They will not form a coalition at all and will not speak with them. So what that leaves the center party is to have to work with one of the either left kind of leaning parties like the Green Party or something like that. So it'll be interesting. Are we going to get kind of this essentially middle ground party that really isn't going to get much done? What impact will it have on the European economy? I mean, I think we've talked about on here, Germany is really the core, especially from an industrial output on the European economy. So it'd be really interesting to see. And then I think the other thing is defense spending wise. I mean, they have a lot of issues there, but you have Russia and Ukraine conflict, and that's not too far. They're not too far removed from that. So it'll be really interesting to see from an international perspective, kind of how all these things play out.
Yeah. Well, it's interesting. The American economy is still the strongest economy in the world. And even though we're, facing a possible recession and we're seeing some negative consequences in the last couple of days in the market, we don't really believe it's going to be a major recession. Nothing looming like 2008 when the home mortgage industry was completely collapsing and everything else. So we'll see. But it does appear like we're heading toward a recession or certainly slowdown. We'll see how bad it gets, right? And then the other issue, of course, we talked about was inflation. And inflation, is going up. Went up in January. And we're at risk of seeing inflation go back up to the point that the Fed might actually have to raise rates. So we hope that isn't the case. The Fed now says that they will not reach their target of 2% inflation until 2027. So you wonder why they lowered rates earlier last year, because if they're not going to see their inflation rate go down to 2%, they probably wouldn't want to lower rates, would they? But they did anyway. So I think the Fed might have had some other objectives there. When they had come into the year claiming they were going to lower 7 times, then 4 times, now the Fed is standing pat. So in 2025, looks like they're not going to do anything until they get inflation to go back down. So we'll see how that plays out. President Trump is pushing for lower oil prices with Saudi Arabia and OPEC, and that will lower inflation and lead to an end of the Ukraine war, which is what they're trying to do. And so that we could see that play out this year. He's also looking for the Fed to lower interest rates, but that could ignite inflation just like it did in January. So we want to make sure that we don't have that inflation. Inflation would kill the economy. We'd have to raise interest rates just like in 2022. So we're hoping to avoid that whole situation. So, Chris, I think that's about what we have. We have some what we see out there ideas, and I know you know about a couple companies buying other companies.
Yep. Yeah, I think one of the big things is Celsius, a popular energy drink. I think they kind of market themselves as the healthy energy drink or the fitness energy drink. They're buying rival energy drink maker Alani Nu for 1.8 billion. So that's interesting to see, and I think it's interesting to note, especially because whenever you have these higher interest rates, I mean, you do see a slowdown in these kind of these companies buying other companies, these mergers, things like that. So it's interesting that whenever we see one pop up, it's a good sign for the economy that people are kind of pricing. And obviously, they're pricing in potentially higher interest costs, things like that. So I think it's positive overall. We'll see if that does heat up a little bit more, the mergers and acquisitions market this year.
Yes. Well, we'll see. And there's a lot of interesting things happening. We'll be back to report them at the next episode. And as this episode started with a recap from Antarctica. We also taped an episode in Chile. So our next episode is going to begin with a recap of the economy in South America. And we're going to hit every continent eventually and tape an episode from there. So watch out for that, folks. Chris, I think that's all we got today.
Yeah, I think that sums it up for the kind of mid to end of February.
All right. Well, thanks everybody for being with us. Thanks for being with us for this episode of Today's Market Explained. We'll be back again very shortly with a new episode leading off with a discussion of South America. And then we'll talk about the economy and what it looks like in a couple of weeks. So thanks everybody for being with us. Over and out for today. Bye-bye. See everybody.
I know.